But I've also noticed that, to really build a sustainable business, a meaningful sized business that can, employ at least, 10, 20 people and be profitable and do good work. It's not easy as an angel investor to be successful, and it's not easy to be successful as a VC fund. You really have to put some resource behind it. So to build a sizable enough business, we then were thinking about what's next, right?
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Hey Milan, excited to have you back after so many years, and so much has changed since then.
Yes, good to be back.
Yeah, since then I think we've come off the pandemic, zero interest rates era has ended, you're now working remotely. So lots of different changes have happened, and excited. Why don't you introduce yourself?
Yeah, hey, my name is Milan.
Yeah.
I've been one of the early interviews on your podcast when you started some years back, and we also work together. I'm a tech entrepreneur, so I've built a couple of advertising technology companies, had one recent exit to a German company called Show Heroes, where I'm still an advisor to, and have since started another business. We started an angel club, which I think we already covered a little bit in the previous podcast, and that sort of evolved to now turn into a platform for private market investing, very high level. I'm also the father of 4 beautiful children. I just made the move to live in Indonesia, in Lombok, on a tropical island. And working remotely as the zero interest rates thing, that has been tough for me as well for the fixed income side. I don't know if we want to go into this.
Well, definitely lots to go into actually. So I guess the big one has been, I think, the big move into building non-public, which came up with Send Angels. This was Orville. But I think the big one is like, why did you make that shift?
Yeah, so Ascend Angels, we started as an angel club, really from my point of view, to invest my own money. So I started with a few $100,000 of my own money, where at some point I made a decision to say I want to deploy 30 to 50 times $10,000 checks. And I realized quite quickly that it's not so easy to deploy $10,000 checks into the kind of companies I wanted to deploy. So I wanted to deploy really mostly into companies that are founded either by repeat founders who've built and sold companies before, or companies that are built by people who have deep experience. And also, I didn't really want to do the traditional angel investing model, which is in very, very early stage companies that are pre-revenue. That was not what I wanted to go after. I really wanted to do co-investments with leading funds, so that I felt that there was some sort of risk mitigation. So really more focused at seed to Series A, seed, pre-A type rounds. And also what I would call tier 1 founders. So founders with some pedigree who've built companies before, or were senior leadership in companies. And I mean, you were also there in the early days, so I think you've seen a lot of my journey. And what I found is, when I did my first couple of deals, it's actually quite tricky to get into the best rounds, because these are usually oversubscribed, or at least they have a great lead VC, they have a solid term sheet, and they don't need 10, 20K angel checks, unless perhaps it's for strategic reasons. But I'm not going to be strategic to everyone, right? I may be strategic to folks who in marketing tech, advertising tech. I may be strategic to people who are looking for a European bridge, because I have a large German network. But I may also be interested in a biotech company, and I have no experience there. So that sort of led us to then building a model where really in the beginning we just pulled together more people to join our community that are themselves founders and have deep experience in one category or another. But of course, all accredited investors, meaning that they have to have at least $1 million in net assets, excluding their primary residence under Singapore law, or $300,000 in earnings over the last 12 months. And so we kind of got a great group together of people who understand certain verticals very well. And that gave us the ability, and so it started with 10, 15 people, and then it was 20, 30, 50, 100, and eventually a few hundred people. And that gave us the ability to firstly assess deals in a much more efficient way, because if it's a, let's say, person X sends me a enterprise SaaS deal that's a company servicing the commodities industries. So I'm not super deep on SaaS. I understand SaaS to some extent, and I understand almost nothing about commodities. Now I look at my network and our club, and there will be several SaaS founders. There might even be a C-suite from a SaaS unicorn in there. And I have several people who are in commodities, right? Maybe family offices who have traditional businesses in commodities trading. And so now we can run this by multiple people and therefore learn very quickly if this has a real market. And we can also now use this network to check about the founder's integrity, basically get references, unsolicited references on the founders. And so that helped us a lot. And I think that's what really kind of kicked off Ascend as a model. And apologies, really to answer the initial challenge I've had, which was, I have some stories. I think Fabrice was here at your house before, ex-Lazada, where I tell people, hey, okay, here's my 10K, and they say, sorry, Milan, minimum 100K. And I say, what if it's 20K? Like, no, man, 100K, that's what my VC is saying. And so then now we have the ability to also bundle basically a bunch of interested parties together in a vehicle where then they have their 100K minimum check size and they get multiple angels, and the angels who are lesser experienced in that field and might like the founder, the space, the traction, can also gain insights from the other angels who understand the space much deeper. And we're sort of all helping each other. So it's really a community-driven model, a network-driven model that's I would say very much a virtuous cycle. We started this really as a hobby. I was still running IVS, which we then exited to Show Heroes, Chengwei and me, really, really very much as a hobby. So there was no intention in the early days to build this into a really, really big business or anything. It was just meant to be a hobby. And of course, we need to cover the costs, etc., of setting up these vehicles. So there's some charges on basically corporate secretarial work, but it wasn't really meant to be a big business. And as I went through the exit and then also managed to kind of, got through my earnout relatively quickly and managed to be able to really full-time focus on investing. And that's what I wanted to do. I wanted to spend my time more on investing. I found myself really enjoying the work and enjoying the intellectual side of this. The intellectual side of investing is actually super interesting because, when I was working in advertising technology, I would wake up every morning and think about how can I show more ads to people, how can I make sure that people buy more, burgers or shampoo or whatever the advertiser wants to sell, which, is obviously there's a big market there. But you're basically looking at one problem all the time. And the interesting thing about investing is you really shift your focus a lot between different verticals, and because also industries change so quickly and technology changes so quickly. So now I'm probably deeper on some other verticals than adtech because of investing. My brain is constantly stimulated by looking at all these different things. I really enjoyed it, and I wanted to spend my time full time on this subject matter of investing. But I've also noticed that, to really build a sustainable business, a meaningful sized business that can, employ at least, 10, 20 people and be profitable and do good work. It's not easy as an angel investor to be successful, and it's not easy to be successful as a VC fund. You really have to put some resource behind it. So to build a sizable enough business, we then were thinking about what's next, right? And the initial thoughts were, well, okay, what are the options? What do angel clubs usually evolve into if they don't just stay angel clubs? They can evolve into an accelerator or an incubator type model. They can evolve into being a fund manager. That's probably the most common. There's some great examples with Ice Angels. Shout out to Robbie. I think they've done a tremendous job in New Zealand, really turning an angel club, Ice Angels, into now Ice House Ventures, which has become a powerhouse of funds basically in New Zealand. And we figured that here in Southeast Asia, you actually have almost an oversaturation of funds, not enough exit liquidity downstream, and therefore it's quite a difficult game to play. There hopefully will be some winners and some fund managers who will show significant returns and DPI, distributions per capital, back to their LPs, to their investors. But at this point, this isn't really a proven out thesis, right? And so from a fund manager's point of view, at some point, you have to go after larger family offices, ideally institutional capital, sovereign funds, etc. And that didn't seem to us as an easy thing to do. And so we were thinking, okay, what does the market need? And what are the problems in the market in terms of early stage investing? And that led us on a path on really focusing more on a platform business where we figured, hey, what if we could build technology that provides more transparency and more liquidity to investors within this whole realm of early stage investing?
So I think lots of different things that you touched upon. You said that you feel like there's an oversaturation of funds in Southeast Asia and there's not much exit liquidity. So let's unpack that a little bit. What do you think is going on in Southeast Asia?
I mean, it's a good question. The high-level dynamics I observe and discuss with a lot of other fund managers and friends, angel investors and LPs as well, family offices that I'm in touch with and speak to regularly. There are a few factors. One is there's a large amount of capital there. So I'll give some example, and I'm not sure this is totally accurate, so don't quote me on it. I've read numbers somewhere between 5 to 10 billion are in circulation for being invested into early growth stage venture, institutional capital, family offices, etc. in a, let's say, 4 or 5 year period. Now, what does a VC or an institutional investor who leads a round of a Series A, B, let's say AB VC, Series AB venture capital round own in a company at exit? I think the data says it's like 6-7%, but let's say it's 10%, right? Just for argument's sake, to make the math easier. So that means you would need roughly 50 to 100 billion in exit liquidity in a 5-year period, 10 years from now, if we assume a 10-year close-end fund life, just to return capital to investors. Now, to have a decent VC-like return, it should be really 3x, 4x. So now we're talking about, quarter to $500 billion of exit liquidity needing to be available for everybody to be successful, for all institutional venture capital in ABVC to be successful. And I think that is just absolutely not going to happen, unfortunately.
Yeah.
And it's not just that we're going to miss it by a bit, we're missing it by miles. There's no tens of billions in exit liquidity. There's probably not even 5 billion in exit liquidity per year, right? If you think about that and you compare it to the available capital that I'm probably not aware of all of it, right? I mean, there's probably nobody's really aware of all of it. There's lots of pockets in corporate venture capital. There's pockets in obviously traditional venture capital and private equity that all play in the space. And surely some will be successful and drive great returns. But the macro environment just doesn't allow for everybody to be successful. At least that's what the data shows now. I think it's a factor of many things, right? So I think it has to do with, one, the public markets not being as mature in Southeast Asia. So I think Thailand and Malaysia have sort of, at least from what I hear, a bit more buoyant kind of liquidity markets from retail. You don't really have that yet. IDX, I mean, most of the stuff trading on IDX is not tech, right? It's traditional industries. So that's one big factor, I think, is that exit liquidity is not really there. You do see exits, but most exits are between sort of 50 to a few $100 million. So the unicorn exits is really very rare and really very, very rare. So then the kind of power law system of VC investing is really difficult in Southeast Asia. It works in the US, right? Because in the US, you have unicorns being born probably every day, every other day in terms of just volume of what's happening there. And I think Europe, Japan, China, India, they're markets that have much, much bigger capital markets in general that are a little bit more systemized and standardized already, which I think we don't have yet here in Southeast Asia. And I think that makes the VC market quite tricky. And that's not to say that it won't change. There's a lot of good things in Southeast Asia in terms of overall market dynamics that speak for the market. And I hope that folks will continue to invest here. And from everything I see, it does happen. It's just much harder to make money. And I think the way to make money is probably different than what people expected 10 years ago. So rather than sort of the traditional power law investing of venture capital, where you have a portfolio of 20, 30 companies and you expect 2 of them to return your portfolio plus 2x, doesn't seem to work very well here. There might be some exceptions, but in the majority of cases, that doesn't seem to hold true. The difficulty is that the market dynamics are very different because, I mean, there's a lot of stuff that, maybe it's repetitive to talk about really, but, you have Indonesia, Philippines, Thailand, Vietnam, they're all very large markets, but they speak different languages, they have different religions, they have different cultures, different behaviors. So it's also not so easy for a company to say, hey, Gojek obviously is in Indonesia, it's also in Singapore somewhat, it's in Vietnam somewhat. But it's not easy to build a tech platform for all markets that's hyper successful, right? I mean, Lazada maybe is a good example of something that sort of seems to work, Shopee. But it's not easy to really capture that whole market. And I think that makes it difficult to play in that way. But on the other hand, I think mid-market private equity has done actually very well in many places. I think certain categories have also done better than others, especially those that have international markets. So I think biotech, there are some great examples, but a lot of them fly very much under the radar. So what we hear about is, like e-fisheries, scandals, and those kind of things. But I think that at least for me, the people I respect and observe, they've been sort of changing their approach on not just following hype cycles, even though, of course, AI, I think, is a space one needs to pay attention to now, but also thinking, okay, well, what I really need to think about is what is my entry point and what is my exit point, right? And the exit point may just be that it's lower valuations, right? The other thing is it could be secondaries, right? So there's more funds now popping up that are actively driving secondary strategies within their portfolios and also normalizing that with founders as they invest, right? To say that, hey, we may want to sell secondaries when in your Series B or C.
Yeah, amazing. And I think one part that you mentioned is that, mid-market private equity is something that you're seeing emerging. And I think you definitely see a lot of people talking about it. What do you think are the drivers of a successful mid-market PE approach from your perspective?
I have to say, I'm actually not that familiar with PE, traditional PE.
Yeah.
And PE business generally is platform business, right? So they may buy a company that is servicing a certain market. Usually or mostly it has some physical element to it. So it's a little bit less sort of hyperscaler tech type dynamics. And they look at companies where they can go in, buy other companies, plug-ons, and essentially drive a lot of bottom line improvements and make it very profitable and grow the thing. And usually look at much, much lower multiples. So it's much more realistic. It's not no castles in the sky of, I'll give you a 50x revenue multiple while you're burning cash and have negative margin. PE doesn't do that, right? PE will, the traditional set of PE, VC is really a subclass of private equity, right?
Yeah.
But the sort of more traditional private equity players, I think they look at businesses more as okay, if we buy this business, we'll take a board seat minimally, we will take a more traditional approach to running this business, right? And so that also means that the entry point that they will buy into is, from a valuation multiple point of view, much lower.
Right.
I think that's a tough thing also for startups, because startup founders, especially as we talked about earlier, tier one startup founders who might already have some money from A16Z or Sequoia, they would have a sense that this can be a unicorn, this can be a huge business. So I think that mindset is, there's some distance in that mindset, because a PE will buy a company on, depending on the growth rate, usually on an EBITDA multiple, right?
Yeah.
Maybe that's somewhere between 7 to 15x, depending on what it is. Maybe they will buy it on a gross margin or revenue multiple, and maybe that can be up to 10x if the company's growing tremendously well. They can see the consistency in the sales and they have reached a certain stage. But it's definitely not what you see in the US in terms of looking at companies at like 50x, 80x revenue multiples, or companies that have below 50% gross margin. That dichotomy is, I think, not so well understood yet by the market and probably not talked about enough. Here, you're kind of better off trying to play in the VC space. At least it feels like you're better off playing in the VC space because you think, hey, my company's worth 20 million, even though I'm only making $500,000 revenue and, and I'm burning tons of money. Versus, look, I'm going to build a more sustainable business. I'm going to bootstrap. There's these two divergent paths that are developing, and the builder community, people who are building companies, aren't quite sort of looped in yet with that. And I think that makes it tricky.
Of course, if you're a founder, it feels nicer to talk to a VC who's giving you VC-like multiples, which is an order of magnitude higher than somebody who's more focused on a private equity of a lower multiple. What's interesting is that you're also building non-public, which is building up access to kind of like private companies as access. Could you share more about what are some of the challenges and opportunities you see with this platform?
Yeah. There's a few different elements to it. So we initially really were very focused on angel-like investments or VC-like investments. And we continue to, through our community, source and also invest in quite a few interesting early stage opportunities. Although over time in the early days, it was really very much, Singapore, Indonesia is the majority of the supply of the companies that we see. A little bit of Vietnam, a little bit of Thailand, maybe. The occasional European company. Now, even that is shifting more towards, okay, if we see, hey, this is a category that people are interested in, that seems to get a lot of attention. And then we might find like, okay, this company here in Indonesia is interesting, but these are some of the challenges, also information that we receive from the network. And then we may find a company in Europe that's solving a similar problem. And we might actually prefer that company because maybe they have a better backing, better investors behind, more investors behind them, or maybe they have just better unit economics, better multiple. So on the angel side, we find that we're starting to globalize more. We just got licensed in Australia, which is really great. So that allows us to essentially open the marketplace up to sophisticated investors without needing to be part of a club, allowing the angel investments to also happen through other syndicate leaders. So through our Australian platform, other syndicates can create their own deals. Our angel club doesn't have to be the lead anymore. So the platform is opening things up to be more of a marketplace rather than just an angel club, which is also not as scalable. One problem that the platform solves is to allow a broader set of startup type investments to be brought to investors and to a broader set of audience who can look at these deals. And at the same time, we try to keep the quality of these startups. We have an investment committee in our business. So we look at things like gross margin multiples. We generally don't like gross margin multiples much above 10x. Of course, there's exceptional cases, but generally in all ventures together, it just seems to be a more realistic entry point if you have sufficient traction on unit economics that you understand, okay, this is the margin this business can drive, how fast are they growing, and what multiple are you willing to pay. So these are some of the factors that we continue to flow in. We also only want to work with syndicates who have a similar mindset, right? We don't want too much craziness on there, right? Because it's the early days, and I think building credibility and building trust with the investors that what we deliver on the platform, what the investor base sees, is sensible. You don't want every random dog food D2C company that has some minimal traction raising $10 million, and nothing against dog food companies. So I think this is a basis of sort of the early stage stuff. Probably more importantly, what we found is that there's a tremendous appetite from, I would call them retail millionaires. They're not retail investors because they're millionaires. So what I would call also maybe mass affluence, or in technical terms, accredited investors. In Australia, it's defined as sophisticated investors or wholesale investors who fulfill a certain criteria that qualifies them to invest in such opportunities. There's a huge amount of them, obviously. I think both Singapore and Australia has a very high millionaire density. And these aren't all startup people, right? A lot of them are dentists, lawyers, accountants, maybe SME owners. They may not be interested in investing in a Series A startup or even Series B startup, but they would be interested to invest in large private companies from the US, from Europe. So our increased focus now will really be on this type of asset class. And there's a lot of interesting things happening there. So I'm talking about SpaceX, OpenAI, Perplexity. These are names everybody knows, but they're not available on the NASDAQ.
Right. And what's interesting is that these opportunities go from A to B to C. And obviously this class of folks are probably upper middle class. Do you also see that flow of capital not only going to US companies, but also going into like local, regional, private companies as well?
At the growth stage?
Yeah.
I think to some extent, but I think the majority will still go to the US. And this dynamic is generally interesting, and also it's quite a large market opportunity really in general. I don't know if you saw, but Goldman Sachs' latest model portfolio report, the only thing that changed is they took a little bit from private equity, and private credit increased versus public markets and bonds decreased slightly. That's the only change. And of course, this is a model portfolio for private banking clients, so people who have a certain amount of net worth. Now, what's interesting is that, you know, this asset class of investing in companies in late stage unicorns in the US, like companies like SpaceX, Perplexity, OpenAI, Anduril, these are probably names that a lot of people have heard before. But generally, you can only really buy them, either you buy them on Forge or EquityZen, these kind of US secondaries trading platforms. But here you'll have a wide variety in price per share, oftentimes trading above the primary price, so where the company has raised money at. And it's very difficult to access at sort of $10,000, $20,000 check sizes. And the companies themselves may not necessarily like that. They don't want their information to be flooded in the market. And if you're a larger family office, you can go to Macquarie Bank or other banks or brokers in the US, and you can buy a larger block of it. But let's say you're worth 10 million, 20 million bucks. Even then, would you buy $500,000 in SpaceX or $1 million in SpaceX? If that's 5% of your net worth, that still is probably too high a chunk for a single asset class. So I think there's a really interesting opportunity there, which is also driven by the fact that 10, 20 years ago, as the FANG companies, Facebook, Google, Amazon, etc., so emerged and became very, very large businesses, this was available to everybody. This was available to retail, right? And the market pricing of these companies has been, to some extent, also defined by retail, right? I mean, that's what creates things like GameStop and meme stocks and these kind of things. Whereas now, I think we're entering an era where companies like SpaceX and OpenAI purposely staying private longer, right? And they're doing tender offers where they're essentially turning old early employee stock and early investor stock into preference shares sometimes, and then sell those to the market rather than going to IPO, because there's enough demand from larger institutional players or larger family offices usually to raise more and more money into the company and also provide liquidity for earlier investors without having to be public. This asset class isn't widely available yet, not even to accredited investors. So I think that's really a space where we want to play, and we want to make this more available at relatively fair prices. So of course you will always, as a smaller ticket player, you will always pay a little bit more fees. You don't have to pay ridiculous price per share markups as you might get on secondary trading platforms with very small checks. And also you don't need to put a disproportionately high amount in a single company name.
Yeah.
So I think that's a really interesting space.
Yeah. And, when you think about the future for, kind of like secondaries and, private markets, do you feel like private markets will get larger over time? And how much larger do you think it will get versus public markets?
I mean, it's a good question. I think on one hand, as mentioned earlier, Goldman Sachs has specifically put made that one change. I think it's 1.5 to 2% from public markets to private markets as a reallocation model. And I think that has to do with this situation. It also depends a lot on the decisions of these large companies, right? CoreWeave is now planning to go public. And of course, there's some benefit in these companies going public, because going public, I mean, the NASDAQ or any credible stock exchange is still the best way to provide liquidity and also to have relatively efficient markets and pricing. I mean, it's also scary in a way to think that 2 or 3 big VC players can basically decide OpenAI is now worth this amount of money, or Masasan can just decide this is how much it's worth, and then everybody else pays that price, which is not the case in public markets. So I think there's a real benefit to these assets going public. And I, for myself, also as an investor, hope that more and more of them do go public, because I think that's ultimately where you want to realize your liquidity as a private market investor, and also just creates more transparent pricing and more realistic pricing and comparables. On the other hand, the incentives for companies like SpaceX and OpenAI to stay private are also quite strong, because once you're NASDAQ listed, your compliance overheads, your regulatory overheads, your filing overheads become much, much larger. So the question is, can you actually make as much progress and grow as fast once you're regulated? And I think once you're on a public exchange, and I think that's part of the reason why Sam Altman, Elon Musk, etc., are keeping these companies private longer, because it allows them to react more nimbly. And as long as liquidity is not an issue and the valuations that these companies are raising at are supported by public markets, I think that market will grow. And this asset class, I don't think we're the only ones playing in the space either, right? So you can see many other companies starting to offer these type of assets to sophisticated investors, and I think that market for sure will grow. How much will then of these larger companies shift to public markets is really hard to say at this point.
And last question here is that, you mentioned that you're now moving and working remotely as well, which is a big shift as well. Could you share a little bit more about how that happened and how that's turning out?
Yeah, look, I mean, I was for the last 10 years, and big thanks to Singapore and my mentors, initially Kubun Wee and John Pang, who were my investors in Poster and my first company, who initially brought me here, and then Peng from Monk Hill Ventures, so where you used to work, recruited me to join IVS. I've had a really great time here in Singapore, and I think it's obviously given my career a boost that I think you couldn't have in most places in the world. Singapore is one of those hubs like San Francisco or London or Tokyo, where certain things can happen here, and the kind of network you build is really tremendous. And I think Naval Ravikant talks about this a lot, like where you are really matters. But you are also, I have 4 children, so you're also kind of tied to a place. You live in a city, it's quite expensive to live. You want to do anything, you have to fly somewhere, basically. If you want to have holidays, maybe you can, drive to Malaysia or something. But I never really had the choice to say, okay, I'm just going to go and move to a tropical island, because I think my board members would have been like, what? You're moving to Bali? Why? Right? I mean, you kind of, it's not something I think that's so socially acceptable. Maybe also because there isn't enough data if that actually benefits a company or not. I think in many cases it probably wouldn't benefit. I think, ironically, I actually think there's still a benefit in being together as a team, especially in an early stage company. You just have so much more of this kind of coffee machine chat, or just being able to say like, hey, can I quickly call you into a meeting? I want to ask you some questions. I think that's really, really important. And most companies will massively benefit from having that. But for me personally, I found myself in a situation, after the IVS exit to Show Heroes, where I realized, with this business that we're running, we already have our people kind of all over the place. We have people in the Philippines, in Indonesia, in Germany, in Australia. And, we have a few people here, but the majority are actually not here in Singapore. And I don't have institutional investors. So I don't have anybody to tell me where to live. So I just had this conversation with my wife, and we looked at different places and the cost of living and the quality of life. And that made us decide like, hey, why not, So we just decided to build a big house, which I couldn't afford to do here in Singapore, and try it. And so far it's working really well.
Awesome. Well, thank you so much for sharing. And to wrap things up, I love what you talked about non-public and the progress so far, as well as the public markets and the private markets. On that note, let's wrap things up.
Thanks for having me.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.